Reaching $1 million sounds daunting, it feels out of reach for most of us. But what if I told you there's a milestone that makes it achievable? That milestone is reaching $100,000 in investments. It's about understanding the power of compound interest. Think of it like a snowball rolling downhill. It picks up more snow, growing larger and faster. That's compound interest in action. Your money makes money, and then that money makes even more money. Reaching $100,000 is the first major step toward financial freedom, and that feeling of freedom is priceless. Compound interest is the secret sauce of building wealth. It's like magic, but instead of pulling a rabbit out of a hat, you're pulling more money out of your investments. Here's how it works. When you invest, you earn a return. That return is then reinvested, and it earns a return on top of the original investment and previous returns. Imagine a snowball rolling down a hill. As it rolls, it picks up more snow, growing larger and larger. That's the power of compounding. This means your money grows exponentially over time, not just linearly. In simple terms, you earn interest on your interest, and that's where the real magic happens. The longer your money compounds, the more powerful the effect becomes. That's why starting early is so important. Even small amounts, invested consistently, can grow into a significant sum over time. Don't underestimate the power of compound interest. It's the single most important factor in building long-term wealth. And the sooner you start, the more you benefit from its magic. Let's say you invest $10,000 today. You find an investment that yields an average return of 7% per year. Don't worry, we'll talk more about finding those investments later. For now, let's keep it simple. After the first year, you'd earn $700, 7% of $10,000. Now here's where the magic kicks in. In the second year, you're not just earning 7% on your original $10,000, but on $10,700. This means you'd earn around $749, slightly more than the previous year. Fast forward 10 years, your investment wouldn't just double, it would be close to $20,000. That's the power of compound interest. Now imagine you keep investing even small amounts every month. That $10,000 initial investment combined with consistent contributions could easily grow to $100,000 in a reasonable time frame. This is just an example, of course. Actual returns can vary, but the principle remains the same. The more you invest and the longer you invest it, the more you benefit from the snowball effect of compound interest. There are a lot of myths surrounding investing, and these myths can hold people back from achieving their financial goals. Let's bust some of the most common ones right now. Myth number 1. Investing is only for the rich. This couldn't be further from the truth. You don't need a fortune to start investing. With as little as $50 a month, you can begin investing in mutual funds or ETFs. Remember, it's about consistency and letting your money work for you over time. Myth number 2. Investing is too risky. Diversification can help mitigate that risk. Don't put all your eggs in one basket. Spread your investments across different asset classes like stocks, bonds, and real estate. Myth number 3. I need to be an expert to invest. You don't need to be a Wall Street whiz to make smart investment decisions. There are plenty of resources available to educate yourself, like books, podcasts, and reputable financial websites. Myth number 4. I'm too old or too young to start investing. It's never too late or too early to start investing. The sooner you begin, the more time you have to benefit from compound interest. Even if you're starting later in life, it's still crucial to invest for your future. Section 5. Momentum builds. Why a larger nest egg grows faster. Remember that snowball? The bigger it gets, the more snow it collects with each rotation. The same principle applies to your investments. As your invested capital grows, so too does the amount you earn from interest. Let's say you have $50,000 invested, earning a 7% annual return. That means you're earning $3,500 per year in interest alone. Now, imagine reaching the $100,000 mark. Suddenly, you're earning $7,000 per year in interest. This is why reaching that initial $100,000 is so crucial. It marks a significant shift in your investment journey. Your money starts working harder for you, generating substantial returns that accelerate your progress towards even bigger milestones like $500,000 or even that coveted $1 million. This momentum is what allows you to reach your financial goals faster than you ever thought possible. The key is to stay focused, remain consistent with your contributions, and let compound interest do its thing. Remember, slow and steady wins the race, especially when it comes to investing. Section 6. The power of starting early. Remember that snowball analogy? Well, imagine trying to roll a snowball uphill. That's what it's like trying to play catch-up with your investments later in life. The earlier you start, the better. Time is your greatest asset when it comes to investing. The sooner you begin, the more time your money has to grow exponentially. Even small contributions made in your 20s and 30s can have a significant impact on your long-term wealth. Let me give you an example. Let's say you start investing $200 a month at age 25, earning an average return of 7% per year. By the time you reach 65, you'd have over $1 million. Now let's say you wait until you're 35 to start investing the same $200 a month. At age 65, you'd only have around $400,000. That's a difference of over $600,000. And it all boils down to starting 10 years earlier. Don't let procrastination rob you of your financial future. Start investing today, even if it's a small amount. Your future self will thank you. Section 7. Investing isn't just for the wealthy. Investing isn't just for the wealthy. Anyone can invest and build wealth. Make smart choices and use compound interest. Start with as little as $50 a month. Use low-cost options like index funds and ETFs. Be consistent and start small. Over time, small contributions add up. Investing is for anyone wanting a secure future. Section 8. Practical tips for reaching your first $100,000. Ready to start your journey to $100,000 and beyond? Here are some practical tips to get you started. First, you can't invest what you don't have. Start by tracking your income and expenses so you can see where your money is going. Then, identify areas where you can cut back and free up cash flow for investing. Second, make investing automatic by setting up recurring transfers from your checking account to your investment account. This takes the emotion out of investing and ensures that you're consistently contributing to your portfolio. Third, you don't need a lot of money to start investing. Begin with a small amount that you're comfortable with and increase your contributions over time. Remember, consistency is key. Fourth, if your employer offers a 401k or 403b plan, take advantage of it. These plans offer tax advantages and often include employer matching contributions, which is essentially free money. Lastly, if you've maxed out your employer-sponsored plan or you're self-employed, consider opening a Roth IRA or traditional IRA. These accounts offer tax advantages and can help you save for retirement. Section 9. Diversification. Don't put all your eggs in one basket. You've heard the saying, don't put all your eggs in one basket, right? Well, it applies to investing too. Diversification is crucial for managing risk and maximizing your returns over time. Essentially, diversification means spreading your investments across different asset classes such as stocks, bonds, and real estate. Each asset class has its own risk and return characteristics. By diversifying, you're reducing the impact that any one investment can have on your overall portfolio. Think of it like this. If you invest all your money in a single stock and that stock plummets, you could lose a significant portion of your savings. However, if you have a diversified portfolio, the impact of that one stock's decline would be much smaller. There are several ways to diversify your portfolio. You can invest in different sectors of the economy, such as technology, healthcare, and energy. You can also invest in different geographic regions, such as the United States, Europe, and Asia. Section 10. Staying the course. Patience and consistency are key. Investing is a marathon, not a sprint. There will be ups and downs in the market, but it's important to stay focused on your long-term goals and not get sidetracked by short-term fluctuations. One of the biggest mistakes investors make is trying to time the market. They try to buy low and sell high, but this is incredibly difficult to do consistently. Instead of trying to time the market, focus on time in the market. The longer you stay invested, the more time your money has to grow. It's also important to be patient. Building wealth takes time and discipline. Don't expect to get rich quick. Focus on making consistent contributions to your investments and let the power of compound interest do its work. Remember, Rome wasn't built in a day, and neither is $1 million portfolio. Stay the course, be patient, and you'll eventually reach your financial goals. Section 11. Your journey to financial freedom starts today. Congratulations! You've taken the first step towards financial freedom by understanding the importance of the $100,000 milestone and the power of compound interest. Remember, building wealth is a journey, not a destination. It's about making smart choices with your money, being consistent with your investments, and staying the course even when the market gets tough. Don't be intimidated by the numbers or overwhelmed by the process. Start small, stay informed, and never hesitate to seek guidance from a trusted financial advisor. The most important thing is to start today. The sooner you begin, the more time your money has to grow and compound. And remember, slow and steady wins the race. So, what are you waiting for? Take control of your financial future and start building the life you deserve. The path to financial freedom starts with a single step. Take it today and never look back.